Two forces are about to test this market at the same time, and how they land could set the tone for weeks. The Federal Reserve is set to announce its latest interest rate decision, and major technology companies tied to artificial intelligence are reporting earnings in the same stretch. Either one of those events would normally dominate the week. Together, they are pushing investors into a defensive crouch. Start with the Fed. The central bank has been threading a needle, trying to keep inflation under control without doing unnecessary damage to the economy. Traders will be watching the Fed's statement word by word, looking for any signal about the pace of future rate cuts or how long borrowing costs might stay elevated. That language matters because even a small shift in tone can move markets sharply. The key question is whether the Fed sounds more hawkish, meaning it signals rates will stay higher for longer, or whether it opens the door wider to cuts. A more hawkish message tends to push Treasury yields up, and when yields rise, pressure builds on stock prices, especially in growth-heavy sectors like technology. Which brings us to the second force, AI earnings. Stocks tied to artificial intelligence have been among the biggest drivers of market gains over the past 2 years. That means expectations are already high, and when expectations are high, the bar for a positive reaction is higher too. If these companies show that AI spending is still strong and profits are growing to match, that could reassure investors who have been growing nervous. If results disappoint, the pullback could be meaningful, because a lot of optimism is already baked into share prices. The broader economic picture adds another layer. Growth has held up better than many expected, but there are cracks showing in parts of the labor market and in consumer spending. The Fed will be weighing that evidence as it decides how to frame its message. Markets will likely take their cue from both the Fed's statement and any forward guidance it offers, the hints about where policy might be headed next. Bond markets will be worth watching closely through all of this. Treasury yields do not just reflect Fed policy, they influence mortgage rates, business borrowing costs, and the way investors value future corporate profits. A jump in yields at the same moment AI earnings disappoint would be a difficult combination for stocks to absorb. The practical takeaway: in weeks like this, the details matter more than the headlines. Watch the Fed's exact language on inflation and the labor market, not just whether rates moved. And watch the earnings guidance, what companies say about the months ahead, not just whether they beat last quarter's numbers. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.